Hey listeners, today I'm joined by David Choi, co-founder of USD.ai. We talk about how AI and DePIN projects can access scalable financing without relying on VCs or endless token emissions, a problem that has plagued many DePIN projects so far. We get into how USD.ai works, why hardware is becoming a key collateral class, and what this means for the future of decentralized infrastructure. Let's dive in. Hello, everyone. Today I have David Choi with me. He's the co-founder of USD.ai. David, it's great to have you on the show.
Thanks, Nicholas. A pleasure to be here.
So, before we get into USD.ai, I would be curious to get your story. Who are you?
Yeah, I'm David Choi. My background, I guess, kind of starts from like my first job, I guess, was doing art lending. So I actually collateralized art loans before, collateralized Warhols and Frank Stellas. After that, worked in investment banking for a little while, covering casinos all the way to real estate. After that, been in crypto ever since like really full time 2018, and 2017 kind of really, where I started off doing MEV for a little while before I guess flashbots kind of made the game less fun. Been angel investing and all the way to MEV for a little while over the years, and so it's just kind of been through the cycles of different since DeFi days all the way to pre-DeFi days, which was a very dark time, and NFTs and stuff like that. Started a project called MetaStreet back in 2022, originally to a protocol that was originally designed for low liquidity assets like NFTs, RWAs, and GameFi and stuff like that. Things that didn't really have a price was our priority. And starting USD.ai this year, really been working on it for a few months with this new entity that we had before, with a collaboration with Aether and Beam called Tactical Compute, and just kind of started like figuring out more about the AI mining DePIN industry, and realized it was a great source of collateral that we've solved before for Bitcoin mining, but now we're doing it again for DePIN.
Nice. Yeah, Deepin is one of my favorite verticals that's come out of this industry, and it's like really exciting to see it come to fruition. You're building USD.ai. Why? Why? Like, what problem are you solving for, and what was the aha moment that led you to realize?
Yeah, it was really a matter of deduction from really dealing with productive or illiquid assets. Generally, when you divide up, the financial markets, you can look at it money markets all the way to capital markets. Money markets is really what most of DeFi is. That's why there's oracles, which really looks at something called, mark to market, which is like how often is an asset priced in the market. In crypto, it's like milliseconds, right, or even faster than that. And that is something that's traded a lot. And generally, if things are more money-like and more focused on liquidity, which is what crypto is superior at, then generally the liquidity trumps its utility. Whereas most of finance in the real world, like money markets, is much smaller compared to the capital markets, which is the more productive assets. Things that are designed to be useful and like cash flow generating, and like kind of like houses to airplanes to real estate to equipment. That is that's very pretty low liquidity because it focuses on its productivity rather than its liquidity. But the objective, the alchemy of finance is the more illiquid it is, the more you could charge in interest rates in terms of debt liquidity, and then that's why oftentimes you call back office for money markets, front office for capital markets. So that we were always focused on capital markets. We That's why we kind of the first time we started Ministry was originally focused around like axes, that's like productive assets that were not very liquid, and kind of evolved to like PFPs, but those weren't productive at all. They're just luxury assets, like Veblen goods. And we just spent this exercise of I call it object-oriented finance instead of functions-based. It's kind of like object-oriented programming, where you like kind of look at all the objects in the space that are illiquid, but kind of start organizing it by what's productive. We looked at like node licensees all the way to NFTs and RWAs. But really what sector we were looking for is like things that were crypto native and productive, things that were generally illiquid, and ideally with like a low depth penetration into traditional markets. And really, we came across Bitcoin mining as like a big sector. We're like, this is like a $50 billion of debt industry, much bigger in actual TAM. Most of it's debt penetrated. Um, and then Deepin was the thing right next to it, right? It's effectively the same business models. All the Bitcoin miners are now doing AI mining in terms of compute. But then you start going down the world of Deepin assets, which is very, very wide. And that was kind of our universe. We're like, this is the perfect market to like find yield from because usually fixed income is it's a litmus test of productivity. So it's really just like this process of deduction of like trying to like solve these problems for each of these markets. And that's how we started building these primitives, which were like Oracleless lending because you can't have an Oracle anymore. How do you do like kind of like a yield-bearing token, like 4626, but for asynchronous repayments? So start solving a lot, which I'll get to in a minute, but like start solving a lot of the issues that were endemic to low liquidity assets that DeFi has really never tackled before. So that's kind of like a long-winded story for it was really a matter of like this was the best category out of all the assets that are in the space, and it's I would argue it's really the only RWA that's worth tackling in the market today,
Hmm.
because yeah, I can get into why RWA is superior to DePIN in a minute.
Yeah, and if you could give us an overview of how USD.ai tackles that problem and like the overview of how the product works.
Yeah, so it works. There's a few layers to it, but the main idea is that it really simplifies the yield generation in this sort of lending business and hardware collateralization. We were doing loans before actually, and we've actually done loans where we were collateralizing. Hey, here's a DePIN operator, for example, Tactical Compute that was like using these mobile chips, about like 1.3 mil of hardware, and it was making like 80% a year. But then it'd be better if you could borrow against the hardware, the 1.3 mil, buy another piece of hardware, then mine more. It's like DePIN looping or DeFi looping. It's kind of similar, and ended up making like 200% because it just borrowed, mined, and if it's borrowing at 30%, mining at 80, then you just keep on looping it. And uh, but in order to do that, you have to find somebody who would give the money, so a lender. So you have a borrower making money, the DePIN operator, and then the lender. And we were matching it one by one. There's a very strenuous and annoying underwriting process of like matching one deal by one deal by one deal. And we realized this just it's not going to scale. P2P never scales in traditional markets. It's almost always larger banks that like act as pseudo pools, and recollateralize that debt in order to scale it. Kind of like mortgage-backed securities, a very similar like mechanism. And all of crypto, like Aave is successful. It was originally P2P, and eventually became peer-to-pool. So after that realization, we realized look, we have to find a really fast capital raising vehicle to scale up the borrowing demand because there's so much borrowing demand, like in the market. It exceeds all of DePIN. Like DePIN is certainly like an emerging market, but like the size of how big you can actually like lend against hardware specifically that is tangential to crypto, it's like hundreds of billions. So we needed a really fast way to like raise capital for that process. And the best mechanism is just like a Tether or like Athena, right? Like a Tether's like top 20 holders of U.S. Treasuries, debt instrument. And we realized that a pegged stablecoin like asset, which it's kind of confusing how we define it today, whether it's an internet bond all the way to like a synthetic dollar, all the way to like a yield coin or however we want to call it, like flat coins and stuff like that. That is the best way to integrate into DeFi and really open up the entire capital markets in DeFi. So it was really a form factor question, like what is our product and how is it like represented? 4626 like really is like the best composable like product. So USDAI it's sort of like a synthetic dollar that represents the yield that's generated from a basket of many like productive and collateralized loans.
Hmm. Could you share a specific example that it could be hypothetical or real of how a company would utilize USDAI to finance its productions and how that would impact
Yeah.
the business? Like what? Yeah, and
Um,
speak to the benefits that your method offers over traditional like venture or bank or traditional finance loans.
Yeah, so oftentimes people don't even take loans, especially in this sector. The debt penetration, like I said, it's very low. A lot of times people just raise money in pure cash and equity. Like they're either raising money as like a fund, and it's just not productive, like I said, or they're selling tokens in order to like incentivize a certain behavior, or like to like sell rights into the shares of the company or something like that. But it's really, really expensive. It just like if you think about it, like what are you really giving up to raise that money in order to really get hardware? And hardware shouldn't be, almost all hardware in the world is typically debt finance, solar panels all the way to data centers to everything, because you can't always raise money in equity. You usually raise it with something cheaper like debt. So to give you an example, like imagine you're like a BitTensor miner. So that's a fairly large amount of revenues that are generated. All that tau that BitTensor emits, depending on which subnets you're mining. And you're running like say like 128 like H100s or 30K each. It's like a sizable amount of capital, and you can buy with cash, but buying a house with all cash is also very expensive versus buying it with a mortgage, or you can rent it. So you can rent out the H100s, which it's like $2 an hour, but that's also not that great. Like one is, very rarely is rent a better deal than a mortgage in terms of the cost. It's always better to pay a little more in the mortgage, but then you actually own the asset at the maturity. So it's the same economics as like really renting a house, and like Airbnb it out. And that's kind of why Deepin's so nice, is because there is a rental market. Before, like if I were giving you a loan, like I had to like underwrite you. I had to like, is this guy really going to be productive? Versus like, hey, part of a deep network is making money. Like I actually see that. You can be like one day old, but I know you're productive. So it really changes the game of like what underwriting really is, because you're part of a network, and that is my way of underwriting you. So yeah, they bought like say like that much amount of capital, but they're it's only 1x, like if they're making like 50 to 100% APR a year, and generally these deep in hardware operators do make that rate. They make like up to 300% a year, and they don't really think of it as APR. They think of it as a payback period, which is a very unique like sector term, because they don't really view things as like money in and then you get a percentage. They view things as I get money in and I get money out. Um, so they're making like 100% a year, which means if you're making 100% a year, you'll take any percentage of debt to borrow against it because you're getting 70%, and then buy it again, and then do it again. Typically, what a lot of these operators do, in pretty much every single protocol, is that they wait 1 year, 100% APR, right? And then they buy the hardware to have double the supply and then do it again. That's so slow. Right? You got to wait an entire year to like double the supply side. And I'm like, from day one, you could own it, prove that you're gonna make all that cash flow next year, and then or also the hardware asset that you have, and then borrow against that hardware again, and then do it again many times, and suddenly you have 3 to 4 times growth from day zero. So well, year one, you 4x it, and then you can actually like exponentially increase the supply for a lot of these protocols. This is actually what happened with Bitcoin mining. Bitcoin mining, when it went through from like, the CPU to GPU to ASICs era, and then really in 2013, 2014, the first bonds, the first loans against the hardware started like to appear. And that's when it really scaled up, in terms of an industry. Like, and that's what really popularized like the convertible debt structures to like scale Bitcoin mining, and all of that's off chain, by the way. But it really proves that like crypto like mining equipment, is really really strong debt markets. People will lend to it. So it's just kind of like a synthesis of like a lot of these historical examples, especially pioneered by Bitcoin mining, and just repeating that model for BitTensor miners all the way to you know Dawn miners, which is more like for telecom, Daylight for energy, Glow for like solar panels. Just goes down the list.
Hmm.
The market is very large. They're making a lot of money, and they can make more. And whereas we can invent a yield product as a result of it.
Oh, yeah, that makes a lot of sense. And also, instead of needing to give away, like you mentioned, they, instead of needing to give away a lot of equity through token sales to venture, for example, to raise money, they could instead keep that equity and not have to give away as many tokens to bootstrap
Precisely.
their infrastructure costs.
Yep. And it also helps the Deepin protocols because Deepin protocols usually make money in the sale of hardware, as well as the you know the amount of tokens they have to give away in order to incentivize the network. Where in reality, and additionally, a lot of these Deepin protocols think the hardware is too expensive. They're like, how do I get more entrants on board? Not every use case is like a Helium where you just need like a $500 node or something. A lot of the use cases they need high quality like information, high quality mining, which is why you can't mine everything with you can't mine all of AI with like like a 3080. You need like a H100, something really big and like mission specific. So these different protocols are struggling. They're like, do we lower the cost and of the asset to get more people, but it's just less useful, right? Like, but then the data fidelity or like sellability of what it outputs decreases. Are they actually a productive network at that point? And this is solved also with debt, right? Imagine if you don't have to pay 30K for each one, or you just pay 3K, and then that really opens up the entire market of who can afford it. So it changes the economics of not just the yield that we're generating and operators, but of the entire modus operandi of all businesses in the sector.
Mm-hmm. And so right now, a lot of DePIN projects, they emit tokens as kind of a way to incentivize people to participate in the network. That's kind of the magic of DePIN is people can be owners in the
Yep.
network, and early contributors get rewarded for that. And do you see this new method of capital formation through USDAI as working in tandem with that, or is it kind of
Yes.
trying to replace a large part of that?
Precisely. That's exactly what's going to happen, and it happens every single time. It's just that like what happens, just the way the capital, money works, is that usually, especially in debt, is that you can only give loans against the best operators. This is what happened with Bitcoin. This is what's happening already with GPUs, right? Like CoreWeave can get a loan. If you own like small like few chips, you cannot get a loan. But the revenue is there, right? There is a need for somebody. That's why you have tokens. They literally call it tokens in like in AI mining, like you're mining tokens, even though there's no token involved. Or like Bitcoin, like it's there's rewards up in the air to like mine random problems with ASIC miners and ant miners. So like as a result, like it becomes very centralizing in a sense. But this incentivization system, like it may appear to be extremely democratic in terms of anybody can come in and mine it. And sometimes you can establish these like processes where like the more decentralized you are, like geographically, like if you're in Africa or Kenya, like you suddenly get more rewards because there's less nodes around you. Um, what happens is that there's an operator that owns all of it. Like it ends up being like 3 or 4 operators that like control all the different hardware points because that's a node. But then it becomes and then really the only people that you can lend to are those large operators. We're trying to flip that on the head with like a more decentralized permissionless lending protocol where it doesn't have to be a super hyperscaler as they call it um, in the GPU world, or like it doesn't have to be Bitmain. In the Bitcoin mining world, it can really be anybody that demonstrates that they can mine a network, and we would be able to lower that threshold for you to get a loan.
Yeah,
So we, yeah.
that's really interesting. I'm wondering about how the process works. Like, what are the nuts and bolts behind someone actually? Let's say I run a DePIN. Well, you're targeting more the protocols themselves and not like random miners, like individual miners, correct? Or
We actually do target the miners more than the protocols. Oftentimes, we don't even need to engage with the protocols. It's just that it helps as we look for origination. Like they can tell us who the best miners are, and we can like work with them just to get like scale. But like or like also like the grassroots efforts of like hey, co-market with them for distribution. But for like the smaller miners. But Yeah, I mean it's all part of the discussion. I do think like as we enable um, more interesting financial economics to the Deepin protocol, it doesn't have to be so simple of a design. A lot of the protocols just think, I just give rewards to the miners in a flat way, with some level of economics that changes based on utilization geographically or something like that. With this credit component, with this like hyper scalable like depth component, it might change the way they think about the economics. So dealing with all of the variables that you're describing.
Yeah, that's
But
one of the most exciting things about open public blockchains is there's a lot of emergent behavior that
yeah,
can happen with assets that you can't really foresee until it starts to take shape. Um, uh, so let me get a hypothetical scenario going. Let's say I run a fleet of Hive Mapper drivers, and I have
yeah.
like 50 dash cams right now, and I'm profitable. Do I come to you and like either your foundation or your company, and kind of pitch myself, and then be eligible to receive funding from your users, or how does that work?
Yeah, eventually. I think in the beginning, like because we're an emergent protocol, we'll probably deal with things that are a little more collateralizable than say like Hive Mapper like nodes, because it's just easier to scale the initial like trust and capital, and we just don't we're not prepared for in-home like truly like hard to represent assets, or like it's hard to default on those assets, and we have no redemption value. We do have some ideas how to make that possible. It's going to take a little while before we get to that point. In the beginning, we're actually looking for more things that are in more public spaces like batteries, solar panels, all the way to data center assets like GPUs or servers. Um, those are a little more interesting in terms of one scale and two uh, um, the collateralization in the event of default. Um, Oftentimes in these loan agreements, they're not actually loans in the exact word. They're closer to sale leasebacks. So what happens is the counterparty sells the underlying asset to us, and they have the right to buy back. It's a very familiar um, uh, uh, model when it comes to like real estate or art and other collateralization mechanisms that don't need to be in the format of a loan. But yeah, for example, like doing a sale leaseback on something that like is outside of our of like public domain, like inside somebody's house, or like in somebody else's property, is something we will do in the future, just not right now. Um,
Nice. Yeah, that makes a lot of sense.
yeah.
Um, if we zoom out a bit, I'm curious. So you guys are launching the USDAI coin and pools on Arbitrum, Ethereum, and Solana. Is that correct?
Yeah, those will be the initial pools.
And so that's where people could go to deposits like stablecoins and mint USDAI to like participate in the network, right?
Yeah, they can mint it, they can buy it, depending which one's effectively a cheaper price,
Mm-hmm.
much like most other like synthetic dollar stablecoin products.
That's awesome. And I'm curious, could you talk to me about why you chose Arbitrum, Ethereum, and Solana?
It's kind of like a bridge. So we like the size of the stablecoin market on Ethereum. Like that is still where a lot of the yield is, and a lot of like the yield funds kind of sit. But at the same time, a lot of the collateral is in Solana. So like, a lot of people are mining, are launching their Deepin products and getting the yield generated on Solana. Fortunately for us, like these products are really RWAs at the end of the day, right? They're kind of off chain. So it doesn't really matter where um, the settlement is, as long as you have a bridge that connects both of those ecosystems together. And this might be one of the few times you really do have that natural bridge. Like you're generating yield on Solana, but a lot of the yield farmers aren't on ETH. So we will be multi-chain from day one, and we realized that had to be like it's almost like kind of like when the banks are in New York, but your house is in California. You kind of have that natural bridge that happens with a single protocol. In this case, that metaphor would be like a Fannie Mae. For us, it would be USD.ai. Um, but that's kind of like the nice benefit is because this is off chain, we can be multi-chain. The yield can be generated from anywhere, and then the yield can be distributed to anywhere as well.
Yeah, that's awesome. I like that. I'm curious to get your perspective on why you think so many DPINs are launching on Solana out of all the chains that they could.
I think it's just really good business development and like early like proof use cases. I actually don't think a lot of DePIN protocols think too far about it. There's some benefits, which is like the throughput of a lot of transactions, but oftentimes it's just related to like where people basket premiums on governance tokens and stuff when they launch their token. They're like, you know, there's a few DePIN protocols on EVM protocols, but they just it's not as big as like the Helium example and the first protocols you think of. But you're starting to see DePIN kind of become more agnostic to the chains that they work in. But it's also just like where like the users are. So a lot of the Helium guys and the Hive Mapper guys obviously kind of like have the same nodes. We've seen that behavior where like people have like 10 different DePIN protocols in their house because it's just like that kind of behavior. But Aether is another like GPU related like compute network that's on EVM on Arb, but IONET is on Solana all the way to Helium and a few others. So it's it just leans a little more Solana because of those early pioneer examples of Helium and stuff like that.
Mm-hmm. That makes a lot of sense. What's your biggest concern about launching USDAI? Are there any unknowns or existential threats that are on your mind?
Yeah, so that's actually the entire purpose of the protocol is to avoid those risks and like deal with those risks that keeps me up at night. One is this protocol in and of itself is not going to be as safe as T-bills. Like it's just generally not going to be. But there is a continuous need to over a long period of time to still try to repeg in different like arbitraging fashions. And you kind of see this like evolution of like, hey, you have the safest yield possible, which is like maybe which is like just holding cash, right? You can hold cash, and then you can hold T-bills, which is T plus one, time plus one. That's like a redemption period. It's not instantaneous. It might be for some, but if there's enough demand, like it's a little slower, right? So you go from like the USDC to Tether, which they're actually backed by T-bills as well, to like more like the yield-bearing token, kind of like T-bills, which are less liquid. They do like um, um, ladder maturities of the T-bills. So it gets a little more slower to redeem. The longer the redemption period, the slower the peg, right? But there's a lot of arbitrageurs who like buy cheap and redeem it at a price to like repeg it. Then you have like Athena, which has much higher yield on average over the many months. But it's obviously like it's not the same thing as T-bills, right? T-bills US backed, like backed by governments. They have the USD TB, but I'm not talking about that. I'm talking about USDE. So our product is going to be 30-day maturities, as in like the 30 days is like um, the fast you can ideally get it faster, but that is like there's much higher certainty within 30 days you get liquidity just because of how the way protocol works with effectively the payments every 30 days, and our loans actually mature every 30 days. Um, so that's a little longer. And like I said, the durations get longer. It might take a longer time depending on how much secondary liquidity there is, depending how many arbitrageurs there is, and depending how strong our redemption mechanisms are that repegs the underlying asset. Our protocol is like fully collateralized. It's collateralized in different ways, which is backed by the loans against the hardware, and or rather leases, and that obviously affects the redemption mechanism. Um, it's important to try to keep a soft peg in DeFi protocols because the goal of our protocol is that we're bridging deep into DeFi. A lot of DeFi protocols want you to obviously try to keep that peg as strong as possible because the more deep pegs and like offset events that can like jeopardize the strength of it. We do a lot of mechanisms to make sure that it does try to cover that entire full 30-day period, whether it's an insurance fund all the way to these like new mechanisms that we invented, like Q extractable value, and a few other mechanisms, as well as like arbitrage, like really opening up the avenues so the arbitrageurs can repeg it like quickly. But that's always a risk that we and that's kind of the existence of the protocol. It's not just to bridge the two together, but to bridge it well using these mechanisms and these problems that only we think about. But yeah.
So I'm not sure if I fully understood you. Is it that DPEGs are the things that worry you?
Yeah. Yeah.
Uh-huh.
Because of the time to the time to repeg, rather, not the DPEG itself. I think we have a lot of mechanisms to make sure that they repeg, which is through redemption. Redemption is the strongest thing that's allowed you to repeg. This is what happened with Grayscale as well as Usual Money and a few others, is that they just didn't have a strong connection to the underlying collateral. We do. Usual was like 4-year lockup, right? Like that was the issue. It's like you can't redeem until 4 years, like with underlying collateral, which is ridiculous, right? Like then of course you should trade a discount, or like Grayscale, you literally couldn't redeem until the ETF launched, like until it converted into ETF. Like it was ETT, you actually can't redeem like GBTC into BTC. You can turn BTC into GBTC, but not the other way around, until the ETF launched. Whereas like Athena, you can redeem it back to cash in 7 days. For us, it's going to be 30 days, which is a little longer, but it's we are really pushing the frontier of new collateral types to generate yield from. So, higher yield, higher redemption periods, but hopefully our new mechanisms can help really smoothen that out and really expand the asset selection that DeFi can earn yield from.
Mm-hmm. When I was researching, it said that I was researching on your site, and it said that you currently use T-bills as basically the 100% of the backing, and that the DPIN credit part comes a bit later. Is that correct?
Yeah, it's a transition period, just to build up the initial rails.
And what does that transition look like? If you could, what's kind of the time frame, and what are the steps to get there?
Yeah, so we're starting as 100% T-bills using a protocol called M0, and we'll likely add other collateral types as well, just diversify down the road. But I love those guys over there. And it starts off with effectively 100% T-bills because it's kind of easy to underwrite, and it lets the actual holders of the protocol kind of have a little bit of say in terms of what actually is being onboarded as underwriters. And then this it starts at 100%, and then as you can imagine, you'll get to 1%, 2%, 3%, 4%, get to probably closer to 20, 30% like penetration of hardware loans or Deepin loans. And probably we're not targeting to actually have 100% utilization of the pool. We still want like 70 to 80% T-bills, maybe a little more, maybe a little less, until we actually have our TGE, because that's when people have a real say in terms of like what they actually are comfortable with, what collateral types they want to encourage, what Deepin protocols they actually like working with, which operators are actually viable, and building up that standard. So we call it stage 1, stage 2, stage 3, where we're really focusing on the genesis, establishing the DeFi rails, integrating with money markets, oracles, AMMs. Stage 2 is kind of proving the concept, and the stage 3 is like really finding out those details of redemption mechanisms and really pushing those waters. So it's kind of a growth period. Stage 4, I kind of want to I have a lot of plans for. The key word is actually tax, but won't go too far into it. But there's some interesting mechanisms that we have for post this initial stage.
Nice. Thanks for sharing. You mentioned your TGE. I'm not aware. Is there a way for users who are bullish on your product to get exposure somehow to your TGE, or how is the TGE going to work?
TGE is going to work very similar to many other protocols. It will happen depending on usage, depending on participants and who actually are effectively like de facto like governors of the underlying protocol, which are typically the users in a decentralized protocol. But yeah, we'll have points. So
Nice.
and that's how it fits into a lot of the pendle-like mechanisms.
Hmm. Um, who's maybe a target audience lender? Like, let's say I have some stables and I'm excited about DePIN and AI,
Yeah,
but I also want stable yield without too much risk. Something that I can just park my money in and think about it and not think about.
we have two tokens for the stablecoin versions, which is very familiar with what people are aware of, which is you know USDAI and then staked USDAI, and that's for one's like instantly redeemable, really just one to one to T-bills, and then staked USDAI is also getting the yield from the T-bills, but also is affected by redemption queue, but also gets higher yield from the hardware loans. So staked USDA owners are the only ones that are getting the hardware loans and the T-bill yield. But they have redemption queue, so, a little bit riskier obviously than unstaked, which is instantly redeemable. So those are the two products that we allow both participants to participate in. But USDAI likely will get more points. So the staked one will get less.
Nice. Um, when can people look forward to depositing into your protocol?
We're so I guess we're having this call in mid-March. I'm hoping like in about 4 to 5 weeks. So we a lot of the initial code is done. So and we're built we've if it gives a lot of people confidence. We're using some brand names, kind of like Cantina, Spearbit, and in our previous audits and our previous protocols, we've had no medium high. I think maybe we might have had one medium across like 4 to 5 audits. So um, uh, I'm not saying anything's guaranteed. There's always risk involved with depositing, but we make sure that we ship good code.
Exciting, exciting stuff. Let me see what else I got here. What's a non-consensus opinion that you hold that most people would disagree with?
I think RWAs um, is a very misunderstood and poorly thought out product that isn't based on product. It's actually based on go to market and asset selection. Um, I've been in the space like really looking like into all the different protocols and stuff and initiatives since like 2016. Like, hey, all these like attempts to bring RWAs, tokenize RWAs. I don't even know what RWA is versus a tokenized security, right? You have like represented assets they bring on chain to create on chain like instruments, or you have an instrument that's already security like a T-bill or like a bond, or whatever, and you bring into crypto. Um, all of those, I think, are generally 99% of it is useless, like fundamentally like not useful. It might be changing this age of Trump, but like if you come from like TradFi, um, there's so much money to get to get liquidity to be fine with like most markets. And most of the use cases end up being like some emerging market thing because like they're like, oh, we can't access credit. I'm like, you can't access credit because you're bad credit. Like you're most likely not going to be able to get a loan, or like because historically a lot of the behaviors of that builds credit is like history, right? Historically, you had like the products like yourselves, like in some corner of like a good example is Goldfinch. Like, yeah, emerging market loans aren't going to be suddenly better because you bring it on chain. Like, it's still bad. Like, you're just tricking like shittier underwriters, which is retail. That's literally what happens. Um, in traditional finance, you go to a bank. If you can't get a loan from a bank, you go to a private credit, which is like hedge funds, smaller funds, credit funds. And private credit is the fastest growing, one of the fastest growing financial sectors in all of the financial world. Like they're financing not great stuff right now, just because they have to hit targets and get higher yields. And if you can't get a loan from that, then you're seriously pretty ugly. Like you come to crypto, and that's what's left And this is a go-to-market thing, right? People keep on trying to defend like suddenly we're no, it's 24/7 underwriting. I'm like 24/7 doesn't help with like the credit all of a sudden. Like you're not suddenly monitoring stuff like better. That's an IoT problem maybe. Um, so trying to like bring RWAs into crypto, like you're creating a path of just bad actors into the space. Um, the best yields, really, the other way to think about RWA is like, how do you turn crypto into an RWA rather than the other way around? How do you bring our yields and our innovative products that are really coming from crypto and into the real world? That's the real way you should visualize RWAs as the other way around. You're not bringing shitty assets that come from RWAs into crypto. You're taking crypto native yields that are really what institutions love, right? Institutions also love dumping bad shit on you. That's what they're not going to bring good stuff on here suddenly because you know they want to make the world a better place. They're here to make money and like get rid of bad assets, just like a margin call. Um, a good example is Athena. Like Athena did an incredible job bringing the like institutions that usually never touch crypto, like top hedge funds. I don't know which ones I can say, but he like guy from Athena really brought really interesting like hedge funds that really never touch crypto to really explore the basis trade as a tokenized like representation. And that was the perps yield was not something anybody has really kind of like easily like got access to, and it really opened that up, which is why it grew so fast. Lido did the same thing, right? Lido, like, Constantine, like, had P2P validator, which he was one of the largest operators for, and he kind of vertically integrated that yield so that he, tokenized it, and that he originated it, tokenized it, and then brought it out to institutions. So you see a lot of institutions as a big client base for theirs. So being able to vertically control like a crypto native yield and bring it out to the institutions is that's the true RWA, not this like dog shit like collateral that has happened for I don't know, for 10 years. Like people keep on trying and they're like, yeah, real estate should be on chain. And I'm like, you pull up any book for any real estate loan. And you're like, it's in land in the middle of nowhere. Bring it to any real estate guy. And they're like, this is the worst. This is untouchable. Like this goes to my spam emails. Um, so try, and that's why I like Deepin, because Deepin to me is the opposite of RWAs. Think about DePIN. It's all RWAs, right? But you don't really think of it as like, yeah, that's an RWA. You think of it as, oh yeah, it's a network. You're tokenizing networks in DePIN through the proxy of RWAs, whereas RWAs is tokenizing the past. It's tokenizing things that just didn't work out. DePIN's tokenizing the future. Whereas tokenizing entire ecosystems and really not the hardware itself or RWA itself, but what the RWA represents, which is a node into a stronger network and something of real value. And that is something that traditional finance would love to have access to. But yeah, that's my take. It's like RWA is tokenized the past and it's not worth tackling. Deepin tokenized the future and really represents something that's interesting. The crypto native yield that like I said, 25 to $50 billion of debt is Bitcoin mining debt. Stuff like, people don't view Athena as like an RWA, but it really is, right? It's a CDeFi product. But we don't call it that. But yeah.
I like it. That's a good take. It makes sense. I see your
Yeah.
reasoning.
But soft rant, but like, yeah, I see, I've done RWA stuff before in my past, like a few small stints, and I'm like, wow, this sucks. Like, this is like the worst collateral in history.
One
Like
thing
this is, yeah.
I hear a lot of people get excited about bringing like stock trading on chain. Does that kind of fall into your category of you think that's a bunch of garbage?
Yeah, I think that's tokenized securities. It's not tokenized, it's not RWAs. It's, I mean, 24/7 trading, like, uh, it being on chain, like, I mean, yeah, there might be more order flow and stuff, but like, people have tried doing tokenized stocks on chain before, for a few times. Even like, Do Kwon's like Mirror all the way to previous initiatives. Like, there might be some initiatives that are interesting. I think they're tokenized like coin, but like, what's it unlocking? Is it really a 1 to 100x like better of an experience? Are you going to suddenly do some DeFi protocols suddenly with like this unlocking of hardware? Have you ever talked to like if you actually talk to like a room of 100 people, not just one, but of 100 like crypto farmer types where all the DeFi capital owners are, do they really want to buy stocks? No, they don't. I bought two stocks in my life. One was Coinbase at 420. Obviously I lost money, and then because in investment you can't really buy stocks without like approval. So I never really bought stocks in my life, and I have no interest to. Yes, maybe they tokenize it, and there's some like interesting use cases, but it's just like it's really uncreative. We're trying to invent new protocols and primitives. Like, don't forget like why we invented like tokenizations in the first place, because you're representing ownership of the entire um, network and utility of the network. Tokenizing stocks, just like, yeah, you tokenize revenue. Maybe if there's entirely new use cases, that's actually interesting. It's like maybe it was like all these SPVs of of the secondary markets, but oftentimes people don't want those traded. People don't want private credit traded unless they're dumping shitty assets on you. And I've seen this pattern like, oh yeah, I'm tokenizing a private credit fund. I'm like, it's called private credit for a reason, because you don't want to calculate it at net asset value, because it's going to trade at a discount because you're just dumping ownership on these guys through the liquidity mechanisms, all the way to like, does Stripe really want you to trade the underlying assets? I don't think they do. I don't think they want to deal with like um, share price action. They want to build the companies. So maybe in those cases it might be useful. Like if it's like truly like I said, crypto native, like it starts in crypto and then starts there. But bringing existing old assets on chain, like yes, it could be interesting. I just don't see it as like this big boom that suddenly happens on chain. Some
Yeah.
settlement might happen, but yeah, like I said, if the venues are very strong in traditional worlds and you're improving 10% efficiency, 20% efficiency, like that's going to be a slow process, and it's not going to suddenly make interesting use cases.
Yeah. I was reading a tweet from Diego from Frictionless Capital. He's Solana legend on Twitter, and he said that the real unlock isn't bringing existing assets on chain to trade. It's having new companies like IPO on chain,
Yeah,
and that's kind of exactly what you're saying, and that
uh,
resonates with me.
it's because
And
Diego worked in finance, so he knows very
yeah,
well like the traditional finance, like New York traditional finance, is like incredible. Like I think people forget, they think they want to disrupt finance. Like guys, it's like it's pretty good. Well, you did a lot of innovations there, but yeah, like I said, if it's like truly new, I think there was a project called Inversion by Santiago. That's like a very good example. Like he's trying to be
yes,
natively on chain, so I think that's like a step in the right direction. I'm actually quite bullish on the concept of like, hey, having like true participants that actually engage instead of just voting stockholders, but like actually like having the revenues on chain, unlocking, and his actual sector that he's tackling, doing this category is actually Deepin, right? Because that's the only sector that's really productive in this space, that's actually
hmm
making cash flows. Everything else besides market makers, exchanges, and stablecoins, like, is really mining. It's exchanges, stablecoins, it's stablecoins, exchanges, and then it's mining. Like those are the three real sectors. And let's bring that to TradFi, not the other way around.
exactly. I love it. Love it.
Yeah.
If you weren't doing this, what would you be doing?
If I weren't in crypto,
Yes.
um, my entire background is in like mostly structured finance kind of products. Even technically MEV is kind of that too. But if I had to choose, probably VR. My CryptoPunks VR, because I actually work out of my Apple Vision Pro, like when I travel, like probably 5 hours a day. Like airplanes, the biggest trick is to have balancing. But it's I have an ultra wide monitor in front of me. It's bigger on the Apple VR, and there's no pixelation loss. So
Whoa.
like, yeah, it's actually like I think people missed the Vision OS update 2.2, which was like a few months back. People thought it was like a dog shit launch, which it was. It was no apps and no use case. But now I have like a massive screen, bigger than any screen that I have at home, and I'm very much into hardware, obviously, 5090L. But it's an incredible piece of technology. I think if anybody plays a VR game using a wired system into like a nice quality computer, that's the real VR experience. Like, Microsoft Flight Simulator, with like really like very little loss. Um, I think that has massive potential. I really like what, Apple and Meta and all these other companies are doing. Um, and would like to create more experiences in that world, to mimic, I guess, more economies. And we haven't seen that yet. Mostly because like the TAM isn't that big. Like there's not enough users. If you don't have enough users, you can't really have entire businesses that sit on top of it. But as a passion of mine, like yeah, I absolutely love it. So I'm still a bit of a metaverse guy, but deep down, Deepin's, I guess, play to earn buffer machines. Uh, so that's a sector that interests me quite a bit.
Nice.
Um, Other than that, I mean, in terms if it's not a passion, like yeah, nuclear farms, that's sick. I think that's gonna pump. I think
Nuclear farms?
yeah, like
Maybe
SMRs in
elaborate on that
Texas.
for people
Uh,
who aren't familiar.
it's like these like modular reactors that like it's gonna help scale energy and because right now like it's a real thing. Like I get on call with these data centers in Texas for borrower types. Energy's tapped out like out there. Like it's kind of concerning. Like you have all this AI demand coming in, and there's like a complete supply mismatch. And in the early days, it was not enough GPUs. Now, once you have more GPUs, you need more and more energy, and energy is not as fast as how fast NVIDIA like outputs the data centers, more the hardware for it. So we're gonna have a supply like energy crisis in terms of the actual demands of AGI and all these things that we're trying to create. So to meet that demand, like we have to look at every single source of energy. We're already doing whatever we are with fracking and oil, but and natural gas and stuff. But the only like sustainable use source of yield, which they say like instead of these massive big nuclear farms, you're gonna have smaller ones. The only issue is it's gonna take 8 to 12 years to like normally have a to set these up, but if you really have legislation like really shorten the process, like like the perfect world would be like you can launch these in 3 to 4 years. You can have a bunch of these, and it's like somewhat agnostic, and depending on where you put them, just don't put them near civilization points. It's kind of like Bitcoin mining. There's like a company called Caruso, which originally like did these Bitcoin mining based on the flares in the middle of nowhere for like oil, like gas flares in order to provide the energy. You can do the same thing for nuclear because data centers are typically in the middle of fucking nowhere. So it's kind of nice in that you can put these seemingly dangerous. I don't know, put an animator on these things, right? Make it seem safer in the middle of nowhere, and it's actually like kind of isolated. It might be a great transition point for that. So that's a sector that excites me. I'm not sure if I'd work in it. Maybe I'd do the financing for it, which I'm kind of a
Well,
broken guy.
maybe one day we can finance nuclear reactors through USDAI. Hey, give
Yeah,
it
one
12
day.
years.
Yeah, one day. But yeah, I mean that'd be sick. In the meanwhile, I'll find a solar panels through Glow, solar panel farms. I think that's a reliable sector. But yeah, that I think that's like pretty exciting, just seeing where the future's going, and it gets me excited.
Yeah, I really
Um,
like what you're doing because I'm really bullish on DePIN and stablecoins as verticals in crypto, and it's kind of hard to see how, as a retail investor, to profit from these trends that I see happening in front of me, but I'm not sure how to execute on them to profit. And if I could
yeah,
like fund DePIN endeavors and get yield from that, it aligns with me because I think it's a vision that I agree with, that I see as coming to fruition, and I get a yield from it that I can kind of set it and forget it.
yeah, yeah, exactly. And down the road, like the governance tokens owners, like of this decentralized protocol, will have a better say in terms of where that capital is allocated. You become like a mini Fed of DePIN, and you control the interest rate of crypto hardware. So like seeing where things actually go, depending on liquidity schemes, there it becomes the first time you've had this first order exposure to all the DePIN protocols at once. When somebody says like I want to buy DePIN, what are you going to buy?
Exactly.
You buy helium, and then you're like, well, I don't really like. Some people love helium because they love the concept of geographically differentiated nodes. It's a cool protocol, but then they really care about having exposure to energy, telecom, and compute, and all these other things that DePIN really represents in terms of hardware um, and networks. And
Yeah.
we're trying to
Like
become that basket. It's the first order thing that combines all of them is their balance sheet, and that's what USDAI is.
That's perfect because like I was looking at Glow and learning about them and how they're helping solar farms build out, and I'm like, well, cool, but I have no idea how to get exposure to that. Like, I'm
Yeah.
not going to go set up a solar farm. I don't know the first thing about it, but you're solving that problem.
Yeah, you can buy their
Um,
tokens, or you could, which is equity layer, or it could be the debt layer, which is what we are. But and you can support it too. And maybe like if these
I
protocols do like want to have more liquidity down the road, like at a maturity state, You might be able to get glow tokens as a result of the yield as well, not just the native yield itself. So you might be able to
Yeah.
get both exposures. This mimics a lot of how debt is raised for Bitcoin miners, right? All the way, like Microstrategy also took this idea, which is like, hey, you get yield, but if things go really well, you get MSTR stock.
Yeah.
So like the idea of convertibles being created on chain through mechanisms like us, which starts off by solving the yield layer, and then start solving by like, hey, if enough debt is raised through this entity, then maybe these deeper protocols will incentivize some kind of gains on top. It's kind of like gauge weights, but a lot more connected to productive capital. Um,
Yeah.
but yeah, so that's the world's our oyster here. Like it's the first primitive. I'm hoping to find a lot more use cases that sit on top. We already have like 2 or 3 protocols or like projects that are using our financial instruments to build other financial instruments. One is like RWA that XYZ, other one's like unsliced that XYZ, and they're trying to decentralize equity ownership, and then we're doing the debt ownership.
That's awesome. Um, people who are interested to learn more, where should they go to find you?
Our Twitter is USDAI underscore official. You can also be on our wait list on USD.ai. It's an incredible domain name, I know. So don't feel great when you type it in. I do every time I every time I type it in too. So they can go on there. And yeah, our program goes up pretty soon, probably end of April. And we have a lot of interesting collateral types that we want on board. A lot of yields generate and a lot of protocol support.
It's fantastic. So if you're interested, go sign up for that wait list and keep an eye on your email for when they open up deposits. Fantastic. Well, David, thank you so much for coming on. It was a really fun conversation.
Thank you so much, and happy to be back on here anytime.
Awesome. All right, take care.